Welcome back to another episode of Palisade Radio. This is your host, Colin Cattell. On the show with us today is a new guest to the program. His name is Ali Zamani. He's the managing partner of Overlook Investors, also a private individual investor, and a former Goldman Sachs investor trader with energy, metals, and mining. Ali, welcome to the program.
Thanks, Colin. Pleasure to be here.
So, Ali, you're based in New York, and you used to work with Goldman Sachs from about 2004 to 2012, where you were working with energy's metal and mining space. You also ran a hedge fund after that. So, do you mind elaborating a little bit on your background and how you got into the commodity space?
Sure. I started off my career in investment banking doing oil and gas, utilities, and energy. I moved from that in 2004 to Goldman's prop group. It was called Goldman Sachs Principal Strategies. We invested the firm's own capital, so the partner's capital, in diversified public market securities globally. I think probably at our peak in 2010, we were about $10 billion on balance sheet. I focused primarily on oil and gas, energy, and mining. Within that, my book ranged anywhere from kind of the bottom of 2009 of like 200 million to as much as 600 or 700 million at its peak in 2007 and 2010. We were an absolute shop, but we did take bets. So we did capital structure arbitrage, relative value investing, absolute directional investing. We used a lot of options and hedging strategies. And I did that till 2012. After 2012, I launched my own hedge fund in partnership with a family office. It was very small. We did that for a few years. And I've since moved on. I'm doing some private activities, a roll up in New Jersey, and I'm looking to get back into the gold space. I think it's the right time now.
So having had exposure, both trading and investing in the resource sector, you actually picked up a interest and belief behind investing in gold. And I think a lot of that stems from the issues that you're seeing on a macro level in the United States primarily, but also around the world. Let's kind of start with the macro picture that you see, the debt levels that are coming into play in the U.S. and also Fed policy. Ali, do you want to talk a bit about that?
Yeah, absolutely. I think when you think about the macro is always different. So I think people like to compare the United States or a certain country or the globe's financial situation to some point in the past. And, some of those comparisons are valid and some of them aren't. There's always a different set of circumstances. For instance, I see, the Democratic Party in the United States compares how low our taxes is and says, well, they were very high in the 50s and we did just fine in the 50s. The 50s was a very different set of economic circumstances. For better or worse, the United States was the lone global superpower. Japan and Germany were basically destroyed in World War II, and 80% of the world was operating under extreme socialism or communism in India, China, South America, and the USSR. So the United States had a great opportunity to be an exporter and pay down that debt. The situation now is very different. We find ourselves in a post-World War II debt level situation with debt approaching 100% of GDP, but without the secular forces that we had at the time, which enabled us to pay those down. And mind you, the 50s and 60s ended with a big devaluation in the 70s, despite those secular tailwinds. And the secular tailwinds were demographics. We had a huge baby boom, a huge immigration boom in the 50s. We don't have that now. In fact, the first generation of baby boomers born in 1946 is retiring this year. We had 80% of the world under capitalism, under socialism and communism. That's the exact opposite this time around. So we have real competitors. So those are the two main differences between comparing those timelines. So when you talk, it's kind of like we had World War II just now, and we have the debt to pay down, but we don't have the economic boom that's going to come after it. So that's really that's the big kind of 30,000-foot view. In terms of deficits, we're running about $500 billion a year in the United States. We've been doing roughly that for the last 8 years. Coincidentally, that's roughly what the Federal Reserve printed the last 8 years. So in terms of the private market needing to finance those deficits, there was no net incremental demand. Now, the Federal Reserve has pulled back, but the major central banks of the world, Germany and Japan, are still printing, and that money, through free flow of funds is flowing to the United States and funding our deficits again. But just so you get a sense of the magnitude, we run about a $3 billion IRS revenue program in the United States annually. We spend about $3 trillion the IRS brings in. We spend about $3.5 trillion. In 5 years, that'll be $1 trillion deficit, not a $500 billion deficit. So without federal central bank support, $1 trillion is, I think it's a insurmountable amount of money for the private sector to finance without huge stock market crashes and big dislocations. So the fact that it's so unpalpable and such a big number tells me that the central banks will get back into that game at some point as those deficits expand. And the deficits, again, are going to expand because we have the debt of World War II without the economic growth, and the baby boomers are now retiring. Now, these baby boomers, they lowered taxes when they were working. They implemented Social Security and Medicare for themselves for when they retire. Now they're retiring, and the demographics has totally changed. The young generation is having less kids. The baby boomers are living longer. Their health care is provided for. And the longer they live, the more Social Security you get. And the newer technologies we develop just keep them alive longer. And we have to pay for those technologies and pay for that Social Security. So the demographics and the deficits get me to the kind of the conclusion that the Federal Reserve can never really get out of this game.
Well, Ali, the case is certainly strong, and the 30,000-foot view that you've put together is undeniable, but I want to ask you what actually creates the day of reckoning, because this same narrative has been in play for gold bugs for the last 20 years, and certainly gold has performed very well over that time period, but the last 5 years have been quite destructive for people in the space, especially gold equities. And what's going to change over the next couple of years? Because most of what you laid out has been in play and it's been building and building, yet somehow gold has been weak and the markets have been, the general equity markets have been strong. So what changes that?
Right. So if you look at the history of gold, gold has done best when everything else didn't work. It's always been an asset class of last resort. In the 70s, when you had interest rates climbing and PE ratios contracting, stocks and bonds and real estate did bad. I mean, there's certain properties, landmark properties in New York City that sold for $1 in the 70s because the property taxes were more than the rental rolls on those properties as property taxes escalated and you had price controls on the rental side. So all asset classes did bad in the 70s. So you're going to need that backdrop. So to get to that backdrop, what was really the problem in the 70s was inflation. And inflation, to really get asset classes too badly, when you have high inflation, PE ratios have to come down, interest rates have to rebase higher. The Federal Reserve could theoretically keep interest rates lower, which I suspect they will, but still the underlying inflation has to be there. So if you step back and you look at how you get inflation, inflation really has to come from the real big inflation has to come from an FX trade. Now, if you've ever grown up in India or China or Eastern Europe or South America or the Middle East, you get that when your currency goes down 60% in value, 60% price increases are going to flow through the next couple of years. That's how it always happens. So, Russia in 1997, 1998 had hyperinflation. The ruble also went down 95% in value at that same period. So it's an FX trade. So to get real inflation in the United States, you have to have a big FX trade, which means you have to have selling of the dollar and buying of something else. The difficulty we have is there's nothing else to buy. And if I could give an analogy, the United States currency, the US dollar, is like an Olympic swimming pool. And the euro is like an Olympic swimming pool, and the yen is like half an Olympic swimming pool. Now, our pool is full of water, and you want to take that water and put it somewhere else. Well, there really isn't any good place to go. The Swiss franc is too small. It's a bathtub. The Canadian dollar is like a jacuzzi. It's too small to take that water. So the water just stays there. So it's very difficult to get that inflation, which creates other asset classes to do bad, which creates the trade into gold, until you have the FX trade. So it's going to be a little bit different this time. I suspect the way this goes through is with these huge deficits growing and building in the Western world, the central banks in panic are going to continue to finance these deficits with more and more bond buying. I think ultimately that leads to more and more negative rates globally. Now, I think we're getting somewhere close to 20 or 30% of all Western G20 bonds in the world are trading at negative rates. I think that's come down a little bit in the last couple of months since Trump's been elected. But Germany has negative rates on the short end. Switzerland has negative rates on the short end. Japan has negative rates on the short end, even actually out into the middle and long end in Japan. So I think the FX trade will happen when people have a huge cost to owning these currencies. In Venezuela, the cost of owning the bolivar is the next day it's worth 10% less. Every day it's worth 10% less. So people go out and buy refrigerators to preserve their purchasing power. In the United States, your dollar isn't worth 10% less every day because the euro isn't appreciating 10% more, or the yen isn't. So the way you're going to get that instigation to trade out of the dollar is going to have to be if you really have a big carrying cost. And I suspect that'll be with negative rates in the United States. And when that gets to a point where people don't want to pay to have money in the system, they're going to take their money out. So I think it may be a longer process. I think it's going to be a much bigger process when people finally say, okay, well, we have $1, $2, $3 trillion deficit in the United States, and my bank account is at negative 2%. I'm tired of this. And if gold starts working, more money will move to gold. More people will sell dollars, and I think you're going to get that self-fulfilling mechanism later in the cycle.
Ali, there's been talk of inflation starting to rear its head over the last few months. Have you been keeping a pulse on inflation in terms of the U.S. dollar? A lot of money printing has been done, of course, over the past 10 years, 9 to 10 years, and somehow the U.S. dollar, because of its reserve currency status, has maintained quite a bit of strength. Maybe the tides are going to turn soon?
Yeah, there is a lot of inflation building up in the wage sector. I'm very close to it in some of the businesses I own, and I'm seeing plus 10% wage increases year over year. And, I think that's how people generally think of inflation. Wage increases moving up, that's reminiscent of the 1970s, but we don't have OPEC like we had in the 1970s. We don't have the U.S. taking themselves off of the gold standard like we had in the 1970s. That type of inflation, I think, is very short-lived. I think the Fed can stamp that out very quick, and I think that's what they're doing. For every quarter-point increase the Fed raises interest rates, that's another $50 billion. If it transfers through to the yield curve, another $50 billion in deficits. So the Fed themselves say they want to get up to a 3% neutral Fed funds rate. If the U.S. government has to fund themselves at 3% higher interest rates, but by the way, that's what they funded themselves under George W. Bush's administration. If we just get back to those levels, we're going to be hitting trillion-dollar deficits at this point because the debt has doubled now in the last 8 years. So I think they can stamp that out pretty quick. We're very sensitive to interest rates. We're an extremely levered economy. We're more levered in every facet of the economy than in the history of humankind. So the government's as levered as it was during the peak of World War II. The private sector is getting close to the 2008 levels, but you have embedded leverage in everything we have now. I mean, we have cell phone contracts, we have auto leases, we have margin debt, we have college education we haven't paid for. These are all new forms of finance that are working their way in the system. 15 years ago, if you had a mortgage at 7% and they raised interest rates 1% and your mortgage rate adjusted up, or the new mortgage rate adjusted up 1%, that's a 10 to 15% increase in borrowing costs for a new homeowner. 6 months ago, we were at 3.25 on the 30-year mortgage. We're now at 4.5. That's almost a 50 to 70% increase in mortgage costs for a new time borrow in terms of interest costs. So these moves are huge percentage moves for a very levered economy. Now, a parallel I would show you is a country like Brazil, where they have double-digit overnight central bank rates, and they have to move rates 5 or 10%, and they don't do much because rates are so high, no one has debt. And if no one has debts, the rates move up and down, and rates don't affect people as much. So in the United States, we're very levered. So, I think actually this inflation that's building, the Fed's going to move to counter that, and we'll get 1, 2, 3, 4, maybe even 5 rate hikes into this, and that'll disappear because 5 rate hikes, we're talking about 5% probably on the 30-year Treasury. I think that blows up housing. I think that flattens the yield curve. I think banks start not making money. I think the central bank's bond buying program is going to have to start again to finance the deficits from the Trump administration. So I see them building, but I think it's the easy kind of inflation to deal with, and I think the Fed is dealing with it. The hard kind is going to be this FX move from the growing deficits, I think.
So gold is the natural path for those who will be seeking safety from the U.S. dollar. And you've made the case that gold's certainly a good place to at least put some of your capital. You've been making some pretty substantial investments. I believe you probably have exposure to physical itself, but you've also been looking at the mining companies, royalties. I even have in my notes here, you've been looking at platinum, maybe palladium. Talk to us a little bit about your interest, not just in gold itself, but also these gold equities, which are pretty cheap these days.
Yeah, so I think gold is by far the best investment. I'd say for people that have no experience in investing in gold equities, they should go with the commodity first. I buy it. I have a lot of it. I keep buying it. I think it's the ultimate store of value. I think it's the ultimate, the government could, if what I'm saying happens in 5, 10, 15 years, you have a total debasement of the reserve currencies, the government very likely will make gold illegal at that point, just like they did in 1934 when they had a debasement. So, they did that in China in 1947. There's a long history of it because they're going to have to shore up their currency. So I think now is the time to accumulate it. In terms of gold equities, I think if you look at this cycle, it's been one of the longest. The entire industry has been destroyed in the fund side. So this is going to be one of those that it's going to be a slow crawl from the bottom. The funds aren't there to bid it up. What's left is struggling to finance these multitude of projects that require huge amounts of capital. So I think there's going to be a long, slow base that we're building in gold, but it'll be very healthy. I think it'll end when you start seeing the big generalists in New York get massively involved with gold like they did in 2007 and 8. I'm extremely bullish. I'm getting involved in a lot of these smaller ones where I can put meaningful dollars to work, get a decent size position in terms of percentage to be able to get on the board. I think my biggest risk I have with these investments is management. Management enjoys paying themselves instead of using shareholder money to advance their projects, their gold projects. At the end of the day, I think people invest in gold equities to get exposure to the assets, not to pay management. So in the situations where I can make substantial investments to get some sort of representation for myself and shareholders, I'll do that. Most of the stuff I'm doing right now, I can't disclose, but there's one investment that's been made public recently, and that's Source Exploration. I've taken a decent position in that. I'm now on the board. I've just been nominated chairman of the compensation committee. We've just appointed a new chairman. He was the CEO previously. He's now CEO and chairman. I think you'll see there'll be a lot more moves to happen in that company as we explore our very exciting property in Mexico. We're in the middle of a drill program on that, and as a director, I can't really comment. But it's a very cheap asset by any stretch of the imagination. It just kind of, for lack of funding, the stock just drifted down, and and we're putting a new kind of shot in the arm of life into this company. But dollar per ounce in the ground, I think it's cents on the dollar compared to what's out there.
So when you're looking for a company to get involved in and make a significant investment and spend your time on joining the board, what exactly are you looking for in terms of the ingredients? Source exploration does not have a resource yet, but one can take a guess based on the drill results that have been announced over the last few years that there's X amount of ounces in the ground, and you can come to some type of evaluation metric there. Are you looking for companies that have gold in the ground already?
I think number one, I think you always have to buy these companies with a mindset that asset could be a mine. So the first thing I look at is, does it have the scale in terms of ounces to be a mine? And I believe Source checks that box. I mean, this is a district that's been actively mined for centuries. The last time it was mined was probably almost 100 years ago. There's a lot of, there used to be a mill on that property. There's a lot of small artisanal mines that have been shut down. In preliminary drilling results, which were not preliminary, but drill results that were out the last few years, you can kind of draw your own conclusions that it has enough ounces to be a mine. And being a mine means, you have enough reserve life to amortize the cost of building the infrastructure to operate it. So you don't want to have enough resources to operate a mine for 2 years because you'll never pay back your infrastructure to build that mill. So I think Source has the assets to have a real meaningful production for a decade or more. In terms of, so it needs to have scale to be a mine. It also has to have grade to be a mine. Now, grade is the amount of I guess in this case, gold there is per ton of rock you mine. And for me as a finance guy, there's simple comparisons I look at. I see what other mines are operating in the world that are doing similar type of mining method, underground, narrow stope, long hole stoping, and what type of grades they have and what are their costs. Now, in terms of comparables, I look at Source looks like it has higher grade, and than a lot of the comparables I looked at, so that are operating today. So it looks like it could be a mine very easily on grade. So I look at those two first and foremost. I think if you do that, you kind of eliminate 90% of assets out there. Then the next thing I look at is management. Is management suitable to take this forward? And if management is rock stars, then that's great. If management isn't, then it's not interesting unless I can help change management. And in this case, actually, we have some good elements, and it just needs, I think, a little bit more, a stronger voice on the board in terms of shareholders. So I think management's pretty good. They have a long history with the mine. I'm involved with it, so I feel more comfortable about that. So I think that checks the box. And then I think the last thing is, will the country or the locale allow this to be a mine? And Mexico is probably one of the best places in the world to be a mine. They have a long history. They have good miners. They have a currency that keeps getting cheaper every day. So the mining costs are dropping. They are pro-mining. The government doesn't block mines. Locals sometimes get in the way, but in terms of places to operate a mine, it's up there with Canada and Australia. It's in Nevada. I would say it's kind of right up there. So it's definitely cheaper in terms of the peso. And I think ultimately, if we have the calamity that we probably will have, the peso is a great place to have your cost denominated. So I think it kind of checks those four criteria. And I'm excited about it. In terms of valuation, I think you get those four, at pennies on the dollar compared to some of the other larger publicly traded pre-development, development, junior mining companies out there.
Yeah, it's a great case to be made. Just for listeners interested in looking at that situation, it's Source Exploration, which is SOP on the Venture Exchange. Ali, I find it very exciting when somebody leaves the dark side, in your case being Goldman Sachs, and comes over into the gold space and gold equity space. We need that type of credibility to be lent to our thesis, and you certainly lend quite a bit of credibility to what we're doing, and a lot of our listeners are interested in. If you have anything else to add at this point, feel free to jump in. But it's been a real pleasure having you on the show.
I appreciate it, Colin. Thanks for having me.
Think you understand the junior mining sector, and you think that the participants in the mining sector, junior mining sector, are good people and kind people, hit the bid.
How violent that term could be? It actually could be quite violent. It could be a rip your face off uranium rally.
And the world is always going to need raw materials. It's going to need copper and gold and nickel and so forth.
Totally destabilized. Hey, Troll, did you hear what's going on in Yemen? Or are you too stupid?